If you need a mortgage to purchase a home, then you should expect to pay interest on that mortgage for the time you have it. However, there are ways to substantially reduce the amount of interest you pay, and I'll show you how to do it. I'm going to discuss what mortgage payments are comprised of, how the principal and interest payment portion of the payment is calculated, how extra principal payments affect the amount of interest you pay, and how loans with higher rates and longer terms could potentially save you money versus those with lower rates and shorter terms. So let's talk about mortgage payments and what they're comprised of. So mortgage payments are made up of principal, interest, property taxes, homeowners insurance, and if you're putting less than 20% down or you're getting an FHA mortgage, you'll have mortgage insurance. So the principal and interest portion of the payment always adds up to the same number unless you're gonna have a lower rate or a shorter term based on a refinance. But the principal is the portion of your payment that pays down the balance. The interest is the amount of money you're paying to borrow that money. So over time, you're going to pay back more than what you initially borrowed because that's how the banks make money, on your interest. When you're shopping an interest rate, that's what's being determined and that's what's being used to make your monthly payments and the bank to earn the money that they should receive for lending you the money. Now, let's give you an example of how the principal and interest actually break down on a mortgage. Now, what I recommend you do is pausing this video, going to the website usmortgagecalculator.org so you can follow along and you can actually run your own scenarios on that site. Now, what I'm going to show you is a $400,000 mortgage at a 7% interest rate over 30 years, which is 360 months. It's the most common mortgage that we actually give to buyers because the resulting payment is the most affordable because that's the longest possible term that's available when it comes to mortgages. So the principal and interest portion of the payment, so I'm not including taxes, I'm not including insurance, I'm not including mortgage insurance or any sort of homeowners association fee that there might be depending on the property. I'm strictly talking about the principal and interest portion of the payment. Now, the principal and interest on $400,000 at 7% over 30 years is $2,661.21 per month. What I want to show you is how much it's actually going to cost you to borrow $400,000 at 7% over 30 years. If you take the $2,661.21, which is the principal and interest payment, multiply it by 360, which is the number of months there are in a 30-year mortgage, you're going to come up with $958,035.59. That means on a 30-year mortgage of $400,000 at 7%, you're paying $558,035.59 in interest, which is more than double what you initially borrowed. It's like you're buying two houses at that point. But that's how much interest the bank actually collects and makes from you if you paid for all 30 years, assuming you didn't refinance or make accelerated payments. That's what they're going to make from you on your mortgage. Now, what you can do in order to save money is you can actually make extra payments directly toward the principal. So let's just say you paid $500 extra every month directly to the principal balance, meaning it's going directly to what you owe. It's not going to the interest. It's going toward the balance on the loan in order to knock it down faster. That would mean that on the same scenario, you'd have principal and interest plus more principal, and it would come out to $3,161.21 per month. That's the $2,661.21 plus the $500 extra you're paying every month. By doing this, you would actually cut off almost 7 years from the loan and save $148,714.94 in interest over that period of time that you have the mortgage. So you're turning a 30-year mortgage into a 23-year mortgage, and in turn, it saves you nearly $150,000 over the life of that loan. Now, let's do a comparison because you might say that, well, why wouldn't I just do a shorter loan term at that point in time? And shorter loan terms typically come with lower interest rates. So I'm going to give you a comparison between having a lower rate, shorter term mortgage versus a higher rate, longer term mortgage while making extra payments. And I'm going to focus on the principal and interest just like I did before in these other example. Now, let's talk about a 15-year mortgage. So let's just say you did a 15-year mortgage, $400,000 loan, same way we talked about before. before, at a 6% interest rate. So it's 1% lower than a 30-year, which is typically the case when you're doing a shorter fixed term versus a longer fixed term. It's 180 months of payments, 15 years. Your principal and interest on that is $3,375.43. 3375.43 over 15 years or 180 payments is $607,577.40. That means that you're paying interest on top of the mortgage of $207,577.40, right? $207,577.40 in interest on a $400,000 loan. Substantially less than what you'd pay on a 30-year, right? Where it was over $500,000 that you're paying in interest. But let's compare this to a 30-year fixed rate mortgage at 7% on $400,000. Same scenario we ran before. We know the payment on that is $2,661.21 per month, and you're paying the $958.35.59 overall with the interest. But what if you took out that $400,000 mortgage at 7% over 30 years, but you paid the extra $715 per month that would give you the same payment you would have on a 15-year mortgage at 6%, right? That payment is $3,376.21, as we said. So you're applying that extra $715 on top of your existing payment. It's actually going to knock the amount you pay on that 30-year mortgage down to $681,913.98. So basically $682,000, let's call it. And you're going to pay the loan off in just under 17 years. So you're cutting nearly 13 years or a little more than 13 years off of the 30-year mortgage by making the same payment you would have made on the 15-year versus being stuck with the 15-year. And you may say, well, but I'm paying less if I do a 15-year mortgage at the lower rate. And you absolutely are. But here's the thing. When you have a 30-year mortgage where you're making the extra payment toward principal every month, you have the flexibility of making the regular 30-year payment at the times that you feel you need to do so. You may have extra expenses in a month or things that you plan on doing, traveling, whatever it might be. And you need to have the lower payment in that month and not apply the extra $715 toward the principal. With a 30-year mortgage, you have the flexibility of doing that. If you go with a 15-year mortgage from the very start, although it's going to save you more money and pay the home off in 15 years versus just under 17, you need to make that higher payment every single month. You don't have the flexibility of paying less than that if you ever need to. So as you can see, there are multiple variables that go into determining your monthly payment and the amount of interest you pay over the life of your mortgage. So understanding your options and the flexibility you have when it comes to making those payments will put you in a stronger position financially when it comes for you to own a home. Make sure to subscribe for more mortgage and real estate knowledge and leave a comment below with any questions you have regarding your own scenario. I reply to 100% of the comments I receive.